Stop what you're doing. Seriously, if you own any semiconductor stocks or if you're even thinking about dipping your toes into the massive AI boom, you absolutely need to see this. Welcome to the Explainer. Today, we're doing a 5-model valuation breakdown of power integrations, ticker symbol POWI. Because, get this, despite crushing their Q1 earnings and actively designing the actual power supplies for NVIDIA's cutting-edge AI data centers, this stock might actually be fundamentally broken on paper.
So last week, I ran POWI through 5 distinct valuation models and 2 legendary investing checklists. And honestly, what I found completely shocked me. Right now, Power Integrations is trading at a mind-bending price-to-earnings ratio of 286. Wait, it gets crazier. To put that into perspective, their current stock price is hovering around $85, but their discounted cash flow fair value? It's sitting way down at just $40. So what is going on here?
Look, I get it. It is absolutely terrifying for retail investors to buy into a notoriously cyclical semiconductor market, especially when net margins have suddenly compressed to a razor-thin 5%. That's a real fear, right? But here's the flip side. This company is literally the hidden engine room of the AI and EV revolution. They are quietly building this proprietary gallium nitride technology, basically a super-efficient alternative to traditional silicon that is literally powering the high-voltage data centers and electric cars of tomorrow.
So, are we looking at the ultimate foundational tech play here, or is this just a classic, devastating value trap? What would legendary value investors like Warren Buffett or Peter Lynch actually think about a stock that has shrinking 5-year revenues but a projected billion-dollar total addressable market?
Section 1, the Power Integrations Paradox, the AI engine room story. Today, I'm giving you a clear, actionable framework that you can steal to evaluate this, or honestly, any hyped-up tech stock by stripping away the noise and looking strictly at the fundamental data. By the end of this explainer, you'll know exactly if POWI is a brilliant Buffett buy or a devastating Lynch trap. Let's kick things off with the bull narrative because, honestly, it's a really strong one. Power Integrations is uniquely positioned to capitalize on the massive power demands of AI. How? Through their proprietary Polygon technology. They are actively collaborating with NVIDIA, which is a massive deal, securing vital sockets in their upcoming 800-volt data center architectures. When you combine this with their grid applications, we are looking at a projected $1 billion data center addressable market by 2030. That's huge.
But wait, it's not just data centers. Let's look at how this foundational tech is spreading like wildfire into the automotive sector. This company is deeply entrenched here. They are currently in production or active design engagements with 17 of the top 20 EV manufacturers in the world. They've even landed emergency power supply designs with major Chinese and German automakers. This puts them firmly on track to literally double their automotive revenue this year alone.
And you can see this shift happening in real time. Just take a look at their Q1 2026 revenue mix. Industrial and automotive now account for a massive 41% of their total sales, which is up 23% year over year. This is exactly the kind of pivot you want to see, because it's actively offsetting the 11% weakness they've been experiencing in their legacy consumer appliance segments.
Section 2, the harsh reality, the numbers behind the narrative. Because while that technological story is incredibly bullish, we have to transition to the bear case now and confront some pretty stark facts lurking in their financial statements.
Over the trailing 12 months, despite generating a solid $443.5 million in revenue, Power Integrations saw its net profit margin compressed to a staggering razor-thin 5%. To put that in perspective, that's down from 7.7% the year prior. So the really crucial takeaway here, they are generating the sales, yeah, but they are seriously struggling to actually retain the profit from those sales.
And the red flags don't stop there. Their 5-year revenues have actually declined by 4.2% annually. Plus, their days inventory outstanding currently sits at an uncomfortably high 289 days. Think about that for a second. That means it takes nearly 10 months for a manufactured chip to actually sell. That's a massive warning sign indicating that demand might just not be keeping up with production.
Section 3. 5 Valuation Models Explained, Stripping Away the Noise. To really understand the massive disconnect between that awesome macro AI story and the actual fundamental math, we need to systematically run POWI through 5 distinct valuation models.
Okay, the most striking takeaway from this breakdown is just how uniform the outcome is. Whether we're looking at a discounted cash flow analysis, historical PE comparisons, or price-to-sales multiples against their industry peers, the stock is trading at a massive, completely unjustifiable premium. Like we mentioned earlier, they are sitting at an $85 stock price when the DCF model suggests a fair value closer to $40.
But honestly, the most shocking part? Their current PE of 286 represents a 124% increase over their own 12-month historical average. What does that mean for you? It means investors are paying top dollar right now for future earnings that the company is currently struggling to produce on a tiny 5% margin. The market is literally pricing in a 43.3% year-over-year growth rate just to justify the price it's at today. No pressure, right?
Section 4. The legendary investor checklists, Buffett versus Lynch. The valuation models give us the raw math, sure, but to frame this correctly, let's see how this stock holds up against the legendary investing checklists of Warren Buffett and Peter Lynch.
So when we apply the Buffett checklist, POWI fails on consistent earnings, and it fails on high margins. It's just too unpredictable right now for his taste. And what about the Peter Lynch framework? Well, piling up 289 days of inventory and having a PE ratio that's completely disconnected from the actual growth rate, those signal a massive warning. To Lynch, this looks exactly like a cyclical stock wearing a disguise, masking itself as a hypergrowth tech company.
And this dynamic perfectly highlights a core fear for retail investors. As the analysis points out, the market is currently pricing POWI for flawless, continuous execution in what is notoriously a brutal boom-and-bust cyclical sector. You are basically paying for absolute perfection in an industry that is anything but perfect.
Section 5. Final verdict. Buy or trap. So, after running all this fundamental data through these frameworks, it's time to deliver the final verdict on whether the macro AI story is actually worth the current price tag.
Here is the ultimate dilemma you have to weigh. On one hand, Power Integrations is absolutely building the critical, proprietary infrastructure needed for tomorrow's AI data centers and EVs. That is undeniable. But on the other hand, the underlying math simply does not support the staggering premium you have to pay to own it today. It literally requires an error-free runway for years to make any sense.
The numbers are clear. Until those margins expand and the DCF gap finally closes, you really have to ask yourself, is this truly the unstoppable future of power conversion? Or is it just a textbook Lynch value trap, just waiting to crush your portfolio when the cycle turns? Let the math decide. Thanks for digging into the data with me today on this explainer. See you next time.